So, how is everybody? Good? Cool. I'm doing okay. Pretty good. Relatively productive. Not very busy, but I got a few things done. Yeah, it was a bit disorienting. Okay. So, I've got a couple of announcements to go through, and then the lecture today is on accounting and finance. Close that. So first of all, I wanted to introduce a women's entrepreneurship event that's coming up pretty soon for any of the women in here that are interested in attending. It's called Wine, Women, and Wealth.
Wait, you say wine?
Wine, Women, and Wealth, yes.
Men can't go to that?
It's specifically focused on female entrepreneurs. So normally $25 for the tickets. I have access to free tickets if anybody wants to go. So if you're interested, email me and let me know, okay? And I will pass you on to the source with the tickets.
What date is it?
It is...
Is there a men and beer one?
What's that?
Is there a men and beer one?
Not currently, but April 1st, 3 to 6 p.m.
Where's beer? You'll have to be link-wise.
So if any of the women in here are interested, let me know, and I will forward you on to the person that has the tickets, okay? And the announcement is on the information section of Blackboard under other materials. Okay, so that's that. Poster-wise, I still need a poster from due dates. When you guys close to getting that? I got Atrix. Thank you. It looks good. What you'll send now? Okay. And Nick, I still need posters from you guys. No. I like it. It's good the way it is. When can you send it, Nick?
Tomorrow, latest.
Okay, that'll work. And then I wanted to remind everybody in here about the weekly update emails that I wanted to get from you guys. I only got two update emails from anybody last week, so not you guys, no. So please remember to send me weekly update emails on what's going on, and this week you need to send me your customer vignettes, okay?
By Friday, yes?
Huh?
Is it by Friday deadline?
As soon as possible. So that's that. Let me go down to the PowerPoint now. Yes, Derica.
Okay. When can we give you our customer vignettes? Because we're waiting on Google. That's how we can. Oh, you
Okay, that's what I asked earlier.
Yeah. Okay, so down to course documents. So, I want to talk a bit about collecting money first, and then I'm going to go into financial statement analysis and ratio analysis and financial statement preparation. So, hey Omar. So it's surprisingly easy to collect money online. For transactions up to a few $1,000s, you can actually use PayPal or eBay without any credit approval process whatsoever. It takes about 10 minutes to set up. You put a button on your website that says "Pay here," and that's it. It's attached to your bank account, and it's just that simple. So it's for those of you who have never collected credit card payments from people, or from you're starting your business and you're not quite sure. Well, do I take a check? Do I take cash? Like, what when somebody's finally ready to pay? What do I do? It's pretty easy to just put a button on your website from PayPal. So all you got to do is just go to the PayPal website, download the button onto your website. Businesses or individual entrepreneurs, that have decent credit ratings can also get larger per transaction sums from PayPal. You can also use merchants like TSYS, Merchant Warehouse, or Advanced Payment Solutions. And basically, each of these vendors charges a fee for a few percentage points for each transaction they process for you. I've listed a couple of different sources here in a table for vendors that provide this service. Just FYI for you guys to know for the future. So that's that. Getting into to budget planning and estimation, revenue and cost estimates. So, excuse me. The basic equation of profit equals revenues minus costs is relatively straightforward, but a big problem that many startups have, and both of my companies had this problem when I started them, is that revenues are too low and expenses are too high. So whatever you think your revenues are going to be, you should start out planning that they're going to be a fraction of that, rather than whatever you thought they were, divide it by 5, divide it by 10, and that's probably a better estimate for what your initial revenues are going to be. Whatever you think your expenses are going to be, they're probably going to be a multiple of that. So whatever you think the expenses are going to be, multiply it by 5, multiply it by 10. That's probably what your expenses are going to end up being for a new startup business. The business will consume almost, if not all, of its own revenues. So realize that you're not going to make a salary off this business when you're first starting out. It's just going to pay for itself, but not pay for your life.
Isn't for the most part like 2 to 3 years before the business starts paying itself back?
Yeah, I usually plan on at least 18 months. So year and a half at least. And then finally, realize that the company is going to consume every penny you can beg, borrow, or steal. So make sure you've thought ahead about your capital acquisition plan and what you expect your costs to be, so you can go out and ask for the money you're going to need. Continuing with revenue and cost estimate stuff, what are customers reasonably willing to pay? You need to make sure this is why I'm having you develop customer vignettes, so that you have an idea, a ballpark of what the market is out there for your services or products. And you need to estimate your revenues based on customer acquisition goals and the price charged. I have product service vignette here. That's something that I am not focusing on too much in this class, but basically after you've done your customer vignettes and you've identified target markets, when you do your guerrilla marketing campaign, you attach a product service vignette to each guerrilla marketing campaign, and it's on those that you should base your revenue estimates. For your expense estimates, think about all the possible expenses you may have to spend money on. For variable costs, there's things like raw materials, labor, taxes, and benefits. Think in particular about what quantities you need to buy things in. A lot of times you can't just buy one of something, you have to buy 10 or 100 or 1,000. That's the big problem with cost estimates a lot of times. Marketing costs, they could involve brand development, advertising, networking, and that includes meals and expenses and transportation. Overhead costs like office space, utilities, telecom and internet information systems, both hardware and software, product development, training, IT services, accounting and legal services, etc. And then executive compensation is something you shouldn't plan on having a lot of to start out with, but eventually is something you need to plan on as well. How much are you going to actually be able to earn off this business? So, revenue and cost planning tools. This is the key task this week that I want to focus on. I've provided a couple of different tools for this, but the main tool that we're going to use is an Excel template that I've prepared for you on how to prepare financial statements. So there's a couple of other resources as well from the Service Corps of Retired Executives and from our Small Business Development Center here. But we're going to focus mainly on this first one, the Excel template that I'm going to show you guys here in a second. Ratio analysis. Why is it important? So it's possible to calculate different ratios of the finances in your business, like how profitable is it, how liquid is the business, or basically how well are you able to pay your bills, how much debt you have versus equity, and activity measures showing how the speed and tempo of which money is flowing in and out of the company. So all of these ratios are basically there to give you a reality check. God, excuse me. No, not really. I just like sleep.
An hour take away for your job?
No. I slept pretty well last night and woke up fairly early, so I just like yawning. I'm actually pretty well rested right now. So all these ratios are here to sort of give you a reality check on how does your business compare to normal businesses in your line of work. And we'll get into that a little bit later. Some important ratios to know how to calculate: gross and operating profit margin. So those are listed there for you. Current ratio, long-term debt to equity ratio, average collection period, and I've given you a whole bunch of additional information on more ratios at these two websites here that I've listed. So being able to calculate those ratios and compare your company to other companies in your industry is an important skill to have, to be able to do a reality check on whether your revenues and expenses are similar to other companies in your line of work. And then finally, there's two main sources for where to get the ratios for your industry. One of them is a hard copy document in the library that I've given you the reference information for. Easier is to use First Research industry profiles. That basically gives you a digital copy of the ratios you're going to need to be able to calculate. So that's the lecture slides. Let me go to the spreadsheet here and walk you guys through what I want you to be able to do. This is the exercise we're going to do on Wednesday of this week. So this document way at the bottom of lecture materials for accounting and capital, copy of financial statement example. Going to open that up. So you'll notice here there's 4 tabs at the bottom of this spreadsheet. Statement of cash flows, income statement, balance sheet, and statement of shareholder equity. For those of you who are not accounting focused in your studies, these are the 4 main financial statements that any company has. The statement of cash flows basically records everything that you either brought money in for or spent money on. And you record it by date. You'll notice here the example starting out in January and going all the way through, if we scroll down, revenues all the way through to the end of the year. And then below that, expenses starting in January, February, March, going all the way down to the end of the year. So the exercise we're going to do on Wednesday is entering a number of different revenues and expenses from an example that I'm going to give you, and then being able to use this spreadsheet to calculate your financial estimates for the company. So you'll notice all of these are just recorded as line items here in the first page. The second page is basically a summary of all of those line items. So you'll notice here there's a formula in each of these cells. The formula in this first cell here for revenues from weddings is a sum of certain lines from the statement of cash flows tab. So in order to calculate that, first of all, we go over to the statement of cash flows. And we sort all of the revenues. So highlight all the revenues and go to Data, Sort. And instead of sorting them by date, we're going to sort them by category. So now we've got all of the revenues from birthdays listed together, all the revenues from sports extravaganzas, and all the revenues from weddings listed together. So now, if we want the revenues from weddings, this cell here is the sum, so equals sign, and then the letters SUM, and little parentheses. And in the parentheses, you're going to place the cursor and then go back over to the statement of cash flows and highlight all of the cells that have wedding revenue in them. So you've highlighted all of those, and then just hit enter. And you'll notice that added up all of those cells. Then we do the same thing for birthdays. Enter. And the same thing for sports extravaganzas. Oh. There we go. Enter. And you'll notice those 3 cells add up down here at the bottom to 83,750, which is the exact same as the total here on the the statement of cash flows page, 83,750. So now that we've done that, we're going to do the same thing for all of the costs. So highlight all of the costs, sort them by category, and then go into the income statement again. Highlight this first cell next to variable costs and hit equals sum parentheses. Put the cursor in the parentheses there. Go back over here and look for variable costs. So we're going to highlight all of these variable costs here and hit enter. And then we're going to do the same thing for marketing costs, overhead costs, and compensation. There we got all the marketing costs. Now we go grab the overhead costs. Enter. And finally, the compensation costs. And you'll notice that all adds up there to 77,625, which should be the same as this number here, 77,625. So now that we've added up all of the revenues and all of the expenses, let me show you what the rest of this spreadsheet has. So there's also a calculation of interest expense. So you'll notice here in the comments line, based on 15% interest on a $10,000 line of credit. So you'd see here $10,000 times 0.15 is $1,500 a year. That's basically the interest that you're going to pay if you had $10,000 credit that you're using and you had 15% interest rate. Taxes, you'll notice, are your profit minus your interest expense times 20% as a ballpark estimate. So 20% is in the ballpark of what you normally pay for corporate taxes. So that's a reasonable estimate of what you're going to pay for taxes. So then the subtotal here is $3,700 in additional expenses for your interest expense and your taxes. That brings you to net revenue, $3,700. And then we've got a number here for inventory shrinkage, so 25% of short-term inventory shrinkage. So there's $2,500 in short-term inventory times 25%. That's $625. And then depreciation and amortization is based on 10% of your long-term asset depreciation. That's $2,500 in long-term assets times 0.1 equals $250. So your, yes, Omar. Inventory shrinkage is basically things that get lost, damaged, or stolen. So in a consulting business like yours, you don't really have inventory, so it's kind of a moot point. But in companies that have physical inventory, over the course of a year, things get broken, lost, and stolen. Make sense? So the total net change for year one, you'll see, is C24 right here minus B25 excuse me. So that gives us the net change for the year. Some other estimates that I programmed into the sheet here. You'll notice this goes out year 1, year 2, year 3, year 4, year 5. So these are projections for what your revenues are going to be in the next 5 years. And you'll see in the comments section, year 1 is the totals of the category entries from the monthly pro formas. Year 2 through 5 assumes 10% increases. So these formulas here are just multiplying each year by 1.1 and estimating that that's how your revenues are going to grow. And then for the expenses, same thing. Year 1 is the total of the categories. Years 2 through 5 is assuming 5% increases. So the formula here in each cell is the prior year times 1.05. Interest expense currently is just estimated each year at 15% interest on a $10,000 line of credit. If you pay down that line of credit, obviously your interest expense is going to be less, but the assumption right now is that for the first 5 years your credit's going to be maxed out. We're assuming 20% tax rate for the all 4 years, and then, like I said before, assuming 25% inventory shrinkage and 10% long-term asset depreciation. So that's your income statement. The balance sheet, you'll notice here, has cash, accounts receivable, short-term assets, and long-term assets. So the cash cell starts out with an assumption that you had $10,000 in the bank, and then adds to that the money that you made from the first year of your operations in the income statement. So you'll notice here $10,000 plus income statement tab, cell C24. And we're going to multiply that by 11/12 because we're going to assume that 1/12 of that money is in accounts receivable. So that means that people owe you basically the payments for December, but you haven't collected them yet. So that's why we've got 11/12, 1/12 in accounts receivable and 11/12 in cash. Then you'll notice here as well, short-term assets is started out as $2,500, but then we need to subtract inventory shrinkage. So this is $2,500 minus the income statement tab, cell B25 right here. And long-term assets also started out at $2,500, and you're subtracting income statement tab B26, which is your depreciation and amortization number. So you add all those up, which gives you your total assets at the end of year 1 of your operations. Liabilities is your $10,000 line of credit. So you subtract your liabilities from your assets and you get a total shareholders equity number at the bottom there. And that shareholder equity number is then taken over to the statement of shareholder equity sheet, and you basically multiply that number by the percentage that each of the shareholders of your company own, and that gives you a report on what the total equity is that each owner of the company has at the end of each year. So that's the formulas in the spreadsheet. Now I want to talk briefly about ratio analysis, and we'll call it a day. So if we go back to the income statement here, one of the most important things to know how to be able to do in small business finance is to be able to calculate whether your business is similar to other businesses in its expenses and revenues, or whether there's something that's very different. So in order to do that, we need to go to the library's databases first of all. Database search, and we're going to go to the database called First Research Industry Profiles. Click go. And now we just need to enter the type of industry that the business is in. So this example that I had was actually a bakery and catering service. So I'm going to type in restaurants as the industry, and you'll see here restaurants quarterly update. Click on that, and that brings us up a report that looks like this, and then we need to scroll all the way down to the bottom of this report. At the bottom, towards the bottom of the report, there's a section called financial information, and if we scroll down a little bit in that, you get to a place that says company benchmark information, and that gives us information on the income statement. So that tells us what the gross margin should be, what officer compensation should be, what advertising and sales should be, and what other operating expenses or what overhead should be. So if the gross margin is 55.5%, that means that the variable costs, so gross margin is just net sales minus variable costs. So if gross margin is 55.5%, that means that variable costs are 44.5%. So we go back over to the spreadsheet here and just type equals the total revenues times 0.445. You'll see variable costs for a company like this should be $37,000. Our variable cost estimate is only for 12. So that's a red flag that our variable cost estimates are probably too low. Since normal companies in the industry have almost 3 times that much in expenses, we know that there's something wrong with our estimates because they're not the same as the industry average. We can do the same thing with marketing costs. So if we look at advertising and sales, it's supposed to be 2.1% of revenues. So we hit here equals total revenues times 0.021. So according to the industry average, marketing costs should only be about $1,700. We've got $7,000 in marketing costs. So we're expecting to spend way too much on marketing right now compared to how a normal company in the restaurant business is. So that's another red flag that we need to plan more conservatively for what our advertising expenses are, our marketing expenses. You can go through and do the same thing for overhead costs and compensation. If you do that, you'll basically find that overhead costs are in the ballpark. Compensation costs are way too high. So in this example, once we do our revenue and cost estimates and compare them to industry averages, we find that we're expecting to spend way too much on marketing and on salaries and not enough on variable costs. So that's a red flag that we should go back and change our estimates to be more in line with the industry average. That brings us to 1050. For once, I actually used the whole class time. Nick, yes?
You said 10:50.
Huh?
You said 10:50.
Oh yeah, 1150. This clock is still not changed. But yeah, that brings us to 1150, which is the end of class. So make sure to bring your laptops on Wednesday. We're going to do an exercise to basically take this same spreadsheet and enter different data into it and practice doing calculations based on that. So I'll see you guys all on Wednesday with your laptops. Yes.
I'll be out of town from the 3rd to the 5th.
Uh-huh.
I'm not going to be missing. Well, there's stuff be on Blackboard, or I can get it from somebody in the class.
No, it'll be on Blackboard.
Okay.
And the recordings are in the syllabus.
There. I got to go to Arizona for an estimating class.
Cool. Enjoy. Or hopefully you enjoy it.
9 hours sitting in a classroom, not being able to leave.
Maybe not so enjoyable.